Welcome to This Explainer. I am absolutely thrilled you're here today. If you've ever felt totally overwhelmed when people start throwing around crazy financial jargon, well, you're exactly where you need to be. Today, we're going to translate all that intimidating financial vocabulary into a super easy-to-understand system. We are going to completely demystify the language of money, and we'll do it by mapping these terms onto a really simple, logical journey, the life cycle of a dollar.
So let me just ask you straight up. Do you speak the language of money? Because here's the honest truth. Understanding these terms is the absolute secret to taking control of your wallet. When you know the words, you know the rules. And when you know the rules, you can actually win the game.
Here is our quick roadmap for today. 1. Making money and your income streams. 2. Spending, owing, and expenses. 3. The business of making money. And 4. Building wealth for the future. Let's dive right in.
Section 1. Making money and your income streams.
All right, let's start right at the baseline. Income. This is simply the money you earn from work or a business. Think of a local shop owner whose main income comes right out of his shop's daily sales. And closely related to that is earnings, which literally just means the money that you earn. So if that shop owner had a fantastic year, his earnings increased. This is really where every single financial journey starts.
Now, it's pretty interesting how time dictates the exact word we use here. Take a salary. This is a fixed amount of money paid monthly for a job. Think of someone who gets a dependable, steady salary on the same day every single month. But contrast that with a wage. A wage is a daily or hourly payment for work, like a construction worker who gets paid daily wages. The physical effort might actually be exactly the same, but the clock decides what we call it.
And this vocabulary shifts as we go through different stages of life too. Let's look at stipend versus allowance. A stipend is a small amount of money paid to students or trainees, like a college intern receiving a monthly stipend while they learn the ropes at a new company. An allowance, on the other hand, is money given regularly for expenses, like a parent giving their kid a daily allowance for lunch. They're both regular payments, but your life stage totally changes the definition.
Okay, so a really crucial point here is understanding how your regular income can be protected or even improved over time. First up is compensation, which is a payment for a loss. For instance, if someone unfortunately gets hurt on the job, they receive compensation for that injury. Then we have an increment. This is an increase in your salary or your overall value. Maybe you worked super hard this year and got a nice salary increment. And finally, a benefit. This is an advantage or extra help provided by an employer. When a job has great benefits like health insurance or extra time off, it adds real, tangible value way beyond just your base pay.
But hey, we don't just have to rely on base pay, do we? Let's talk about the extra ways to earn. This is the vocabulary of the hustle. A bonus is extra cash given for good work, like getting a nice Diwali bonus at the end of the year. Then there's commission, which is an extra payment specifically for selling something. Think of a real estate agent earning a commission on the houses they sell. If you're the creative type, you might earn royalties, which is money generated from creative work, like a writer getting royalties on a best-selling book. And lastly, an award, simply a prize for a great performance, like winning a cash award for being the absolute best teacher in your district.
Moving right along to Section 2, spending, owing, and expenses.
Now, pay close attention because mastering this next distinction is absolutely the core of personal finance. An asset is a valuable thing that you actually own. A house, for example, is a massive asset. On the flip side of that is a liability, which is money you owe to someone else. If you took out a mortgage to buy that house, well, that loan is a liability. It's simple. Assets put value in your name, while liabilities demand money straight out of your pocket.
So, how do you keep those liabilities from totally overwhelming you? You have to manage your expense, which is literally just the money you spend. If your monthly expense is running way too high, you absolutely need to follow a budget, a clear, defined plan for spending your money. Think of your budget as your ultimate toolkit for keeping your finances completely under control.
And this brings us to a really direct cause and effect relationship in the financial world. A loan is borrowed money. You actively go out and take a loan for a house or a car. The direct result of that action? Debt. Debt is the money you must repay. Because you took the loan, you might find yourself in heavy debt. So the loan is the event that happens, but the debt is the ongoing reality you have to live with until the whole shebang is paid off.
Let's expand on these obligations a bit. Fees are money paid for services, like paying school fees for your kids. Tax is money paid to the government, which we all dutifully pay every single year, well, mostly dutifully. But I want you to really consider this third term, interest. Interest is simply extra money on top of money. Now, if you're in debt, you're paying interest, which hurts. But as our source points out, the bank also gives you interest on your savings. So interest is this incredible two-sided coin. It can either work heavily against you, or it can quietly work for you in the background.
Of course, not all spending is just about bills and obligations. There's a wonderful philanthropic side to money, too. A fund is money collected for a very specific purpose, like when a whole community donates to a local school fund. A donation is money given purely to help others, such as giving a donation to a charity for the poor. This is the vocabulary of using your money to make a real, positive impact in your community.
That brings us to Section 3, the business of making money. We're going to anchor this business section with the word capital. Capital is simply the money required to start a brand new business. And this often ties right back to our very first section on personal savings. For instance, a passionate entrepreneur might use his hard-earned personal savings as the capital to finally get his dream business off the ground. Once that business is up and running, it generates a whole new set of words. First, you have turnover, which is the total sales of a business. A really successful company's turnover is high. That leads to revenue, which is the total business income. Obviously, you want to see the shop's revenue increasing year after year. But here's the catch. You only actually survive on profit. Profit is the money gained after all your expenses are finally paid. Ultimately, the big goal of any transaction is to gain, to get a profit or advantage. So at the end of the day, you can say, wow, he gained a lot from that deal.
Now, sometimes a business or an organization needs some external help to keep going. And that brings us to these next two terms. A subsidy is government financial help that's specifically designed to lower the cost of doing something essential. For example, farmers getting a subsidy on seeds so they can actually afford to plant their crops. A grant, on the other hand, is a lump sum of money given by a government or organization, like a local school receiving a government grant to build a brand new library. They both provide absolutely vital financial support, they're just structured a little differently.
And finally, Section 4, building wealth for the future. Our ultimate goal here is wealth. Wealth is defined as a large amount of money or property, and as our source highlights, wealth is typically gained through good, old-fashioned hard work. It's really the grand culmination of everything we've talked about: managing your income, keeping a tight lid on your expenses, and making smart business and personal decisions over decades. The path to getting there follows a very clear chronological sequence. Right now, in the present, you have to be saving, keeping money tucked away for the future. You save a little money every month. Then, in the near future, you turn those savings into an investment, which is money used specifically to grow your wealth. Let's say you make an investment in some land. Eventually, in the future, that yields a return, the actual profit from an investment. You get a fantastic return from that land or from your business. It's a step-by-step, chronological journey.
And that timeline leads us perfectly to the endgame vocabulary, passive income, and retirement. You might earn a dividend, which is a slice of profit a company shares with its shareholders. If a company paid you a dividend this year, your money literally made you more money without you lifting a finger. Then, when you finally decide to stop working, you might rely on a pension, which is money paid after retirement, like a grandfather getting a regular, dependable pension check. Alternatively, you might set up an annuity. That's a fixed amount of money paid out every single year to make sure you have total security in your golden years.
And there we have it. We have literally traced a single dollar from the moment it's earned as an income or a wage, tracked it as it flowed through budgets and taxes, watched it help build a business as capital, and finally saw it grow into lasting wealth and a secure pension. You know what? You now speak the language of money. You are completely equipped with the vocabulary to confidently navigate the financial world.
So, I'm going to leave you with one final, provocative thought today. Knowing everything you know now, take a really hard look at your own wallet. Are you currently building more assets, or are you just taking on more liabilities? Understanding the difference is the very first step, but actually applying it, that is where your real wealth begins. Thank you so much for joining me on this explainer, and I highly encourage you to keep exploring these concepts.